Good morning, all. I'm George Kourkouta. I'm editor-in-chief of Startupper GR and Startupper Mag. It's one of the leading media for startups in Greece. It's a magazine at the entrance of the festival. Let's start with a question. How many of you do you know Cambridge Associates as a brand, as a firm? Oh, great. Cambridge Associates is one of, I think, the oldest consulting firm in the US. It controls almost $500 billion in different kinds of investments and several $100 million for family offices and non-profit institutions. We have here with us Dean Dimizas, partner at Cambridge Associates. Welcome.
Thank you.
Would you like to tell us a little bit about Cambridge Associates?
Sure.
And
Sure. Thank you, Yannick, for the introduction. Thank you, George. Thank you, everybody, for coming. Thank you, Lars Lefteris and the rest of the Panathēnea team for hosting us. I'm thrilled to be here and see existing friends make new friends from all over the world. Cambridge Associates for the last 52 years has been advising families and nonprofit institutions like colleges and universities all over the world. We don't sell any products or funds. We help them optimize their asset allocation and invest in the best fund managers in the world. Some are very big and famous household names, many of which were speakers here yesterday and today, and many others are smaller, younger, emerging managers. Also, many of our family clients are very active in co-investments and directly investing in companies all over the world.
Great. So you're looking, so you meet many VCs and many VC managers from all over the world, not from only US, I think. What are you looking when a VC is coming to you? It's better now. Okay. So many VC managers are, you meet many of them every day and all over the world. What are the key traits you're looking?
Our clients invest in all asset classes, traditional and alternative assets, liquid and illiquid, but venture capital is usually a very meaningful double-digit percentage of their portfolios, and we've been helping these clients invest in venture capital for the last 50 years. This is not a new asset class. It's been around for 50 years. We track a few thousand of these VCs on an ongoing basis. Most of them are based in the US, but an increasing number is in Europe and in Asia. I think it's three things that really matter. It's the people, and the people. You know, the same way these VCs themselves try to find very special founders that have very unique attributes, they're outliers, the same way we try to find very special people that will be stewards of our clients' capital. So very often these people don't have track records. You know, people think this is all about the returns and the track records, but many of these people used to be founders of a company, they built something, or they did something else. So in most cases, there are no numbers to look at to say, you know, George has an amazing track record, so I'd love to give him money. So we look for other things. We look for people that are really driven to do this for reasons beyond money. Clearly, everybody wants to make money to invest in venture capital because of the high risk and illiquidity of the asset class. But you want to see managers that are really passionate to find the next Elon Musk, the next Palmer Luckey who's building Anduril, the next Daniel Ek, the next this and that. We're looking for people that are going to be very aligned with us, people that are going to be good business partners, people that take their fiduciary duty very seriously. You know, I was sharing with some people here in this room that, you know, some VCs have more money in companies outside of the fund that they do in their fund. That's an example of a poor alignment. Or some VCs share co-investments with people that are not investors in the fund as opposed to sharing these co-investments with their current LPs. So for us, alignment and partnership are not negotiable. We want people that are going to be hustlers, people that are going to be the cheerleaders for their portfolio companies. You know, the truth is that these portfolio companies are a pile of problems. They have problems hiring people, problems winning new clients, problems with the government, problem with regulation, problems with competition. So these VCs have to have tangible ways they can help their portfolio companies, to hire talent, get in front of key potential clients, help them raise capital. So these VCs have to be out and about, traveling nonstop to help promote their portfolio companies. I think that's also super important. People that can see around the corner, what's the next hot thing? We'll talk about AI or defense tech or physical AI, which are the hottest flavors of today. But very often you need people that can see a little bit around the corner or look for talent in places that other people won't go. There are a lot of people in Silicon Valley, maybe there are a lot of people in Athens, but there are a lot of other hubs of excellence that a lot of talent exist. So you have to go there and find these people. And the last thing I'll say is what we do is long-term relationship building. I tell people that I dated my wife for 3 years before I got married to her. Some people date longer. This is a very long-term relationship building. It's not a short-term transactional thing. I like you, you're a good guy, here's 10 million.
And okay, family offices are very entrepreneurial mind or focused, but non-profitable institutions, are they still investing in VCs? Are they not afraid?
No, actually,
of the risk?
Yeah, that's a paradox. Actually, the first investors in venture capital in the 70s were the Harvard universities of the world. It was the Harvards, MITs, and Princetons and Stanfords of the world that were the first ones to invest in these strategies from the mid-70s. Those were the very early investors in Sequoia or Kleiner, or some of the early firms in the US. Some of them don't exist today. These institutions have the benefit of having permanent capital. They have an infinite time horizon. Some of these universities, including Oxford or others in Europe, or foundations, started several hundred years ago. They're going to exist for several more hundred years. So they have the benefit of having permanent capital with the longest time horizon. So venture capital is a great asset class. It's a very long-term asset class. You're making long-term bets on people, on companies, on founders. So the long-term institutional duration of this capital that these museums, colleges, universities bring is a perfect match for the long-term nature of venture capital.
I see. Interesting. Very interesting. Let's go now to another question about the trends. The trends currently exist in venture capital all around the world. I suppose is AI, I suppose. Bioscience probably comes from the AI revolution. How do you manage all the VC's focus as a company, and how do you match them with your clients?
Sure. For sure, AI is front and center everywhere. But at the end of the day, AI doesn't mean anything. Every company uses AI. Now it's the same way everybody was using the internet 20 years ago. So AI is going everywhere. You hear about all these AI native companies, but it's definitely AI everywhere. Something else that's become very hot in the last few years is hard tech, deep tech, or you've heard the term, I'm sure, yesterday and today, physical AI. Until recently, everybody wanted to build asset-light, B2B SaaS companies or marketplaces, things that didn't require any capital. But now, everybody wants to build, the next NVIDIA, the next Anduril, the next Tesla, the next SpaceX. People literally want to build, rockets or chips or autonomous ships or drone interceptors. So there's been a huge shift of interest in capital and attention because of what's happening in the world. We've seen a massive rise of AI. I think we're still in the very early innings of AI, and that's enabling a lot of things. The war in Eastern Europe and now more recently in the Middle East is creating a much bigger interest in defense tech. That's also a super hot sector in the last few years. Everybody's building drone companies and autonomous ships and drone interceptors. And also the rise of innovation in life sciences and biotech, to a lesser extent because of AI, is also drawing a lot of interest. So that's another area we're very active in, that being biotech more broadly defined. So that's something else we're very excited about. But I would say that these are the current flavors and the hottest areas as we speak.
And I suppose your clients, also a family office, comes to you and say, I want to invest in bioscience?
Usually they tell us we want to invest in the best people and go and find them for us, find the best fund managers that will find the best founders in the world and back them early and stay with them when things are not going well. Some of our clients are passionate about life sciences. You know, everybody has had family members with health issues. Everybody has seen how the improvement and advancements in medicine, in science, in therapeutics can help prevent disease or cure disease. You know, everybody deals with health issues for themselves and their family, so that's definitely an area that people can associate with. And the pace of innovation has dramatically accelerated in the last 5-10 years in the US and China.
Great, great. Let's go to another subject. It's one of my favorite, let's say. I think there are several thousand VCs worldwide, especially in Greece, who have almost 30 VCs, above 16 with targeting startups. Are there too many VCs? And especially, what are some misconceptions, let's say, existing VC
about the
market?
asset class? Sure. For sure, the number of VCs has grown dramatically over the last 10, 15, 20 years, not only here in Athens, in Silicon Valley, in New York, Europe, and Asia. For sure, it's become a much more mainstream asset class. Everybody wants to have exposure to it because they've seen these huge outcomes. So the problem that we're facing is the number of VCs has gone up dramatically, but the number of amazing founders has not gone up dramatically. You know, the analogy that I use when I discuss this with people is the size of the pond is roughly the same, but now you have many more fishermen fishing in the same pond. So I think this is going to make it more difficult to have great outcomes because we have much more capital competing for a finite number of ideas. But that's not only a Greek phenomenon, it's happening elsewhere. So I think this will make it more difficult to put money to work and more difficult to generate dramatic outcomes given that there's much more competition everywhere. I think some of the most common misconceptions about the asset class, I'd say there are 3-4 things. The first one is that venture capital is a very long-term asset class. You know, our brains are wired for instant gratification. People want to see, you know, results right away. The reality is that it takes roughly 3 years for these VCs to put the money to work. The reality is that on average, based on our data, we have 50 years of data on VC funds. On average, it takes 8 years to get the money back. So if George or I or the family office across the streets invest in a basket of venture capital funds in the 2026 vintage, on average, it'll take them 8 years to get their capital back before they get any profits. So you need to make a very long-term commitment to these VC fund managers. They're going to put their money to work in the next 2 years. Then they're going to come back for fund 2. Then after 2 years, they're going to come back for fund 3. And by this point, you know, we're in year 6. You haven't seen a single dollar or euro back. But nothing has changed. You know, it's the same 2 or 3 people that are running these firms. So you have to wait for a long time, and the reality is that it takes a very long time to build companies. Many of you are founders in this room. Many of you own operating companies. It takes a long time to build a company. There are a lot of ups and downs. So I think very often allocators lack the required patience and long-term horizon that this asset class needs. That's for sure is an important element that a lot of people lack, the patience and the duration to wait.
So it's not quick money.
This is not quick money. There are a lot of other ways to make quick money, but venture capital is the opposite of quick money. You're making long-term bets on people, on founders, on company building, and that is a very long-term journey. You know, we say that this is a marathon and not a sprint. So I think the very long-term feedback loop and the very long-term time it takes to figure out if somebody is a good VC or a lucky VC is a very long-term exercise, and there's a lot of noise around this.
I see. Now, if I'm not mistaken, family offices, it's more active in direct investments, in startups also. or co-investing with?
It's all the same. Yeah, for sure. Yeah, go ahead.
Is this
Absolutely.
trend?
Globally, families from China to San Francisco and everywhere in between have become much more active in investing directly in companies over the last 10 years. 22 years ago when I started my career, the word co-investments barely existed, and it was mostly prevalent in buyouts and private equity and not in venture. But over the last 5-10 years, this has really taken off. I think it's a great thing for the ecosystem. There are more sources of capital. The benefit of these family offices is that they can take big risks. They don't report their performance to their limited partners or the newspapers or anywhere else. So they have the benefit of being able to take a lot of risk and having a long-term horizon. One of the big problems that I see, though, is that there's a tremendous amount of adverse selection. The best VCs, the best private equity firms will invest as much as they can in a company once they find it. And then if there's a little bit of extra money, they're going to give it the opportunity to the largest investors. So there's a tremendous amount of adverse selection going on, something that's been circulating widely across the globe through private banking channels or other intermediaries. Probably it means that a few thousand people have already said no before then. So it sounds very exciting for you to invest directly in SpaceX or Anthropic or OpenAI, but for every SpaceX and Anthropic, there are probably 100,000 companies that are not going to do so well. So that's, I think, a key question mark.
Great. We have almost a minute. I would like to ask, as a technical person, about AI. How do you use AI, and personally, and also in Cambridge Associates?
Yeah, for sure. Look, every company in the world, has to be an AI adopter, and you have to be good at AI, whether you're a journalist or an investor or somebody else. I think those people that understand and embrace AI have better chances of succeeding longer term, and whoever ignores it, I think, faces a lot of disruption risk. But across, it's not only journalism or investing, across, medicine, law, everywhere, AI is going everywhere, so everybody has to embrace it. Clearly, there are question marks. Is this worth the investment? Is this overhyped? Is this a bubble? But, speaking from my day-to-day life, we've become much more efficient and faster. If you ask me, give me information, give me a report for this VC fund, maybe it would take one of my analysts a whole week to write a 20-page due diligence report. And now we can connect our AI to the data room of the manager. So a lot of the simple work can be done in a very fast and pretty efficient way by AI. I don't think AI is going to replace human judgment anytime soon, but it's a great tool for everybody to become much more efficient. I feel that I have 2-3 extra analysts or associates on my team because we can do so much more. And what's also amazing, every time we see a new model rolling out every few months, the results are dramatically better. A year ago it was garbage, actually, and now it's very impressive what we get. So every company is going to try to figure out how we can use it to become more efficient, increase our revenues, reduce our costs. And a common misconception is that we're going to start firing people. Actually, because AI increases productivity so much, you have to hire more people because you can do so much more with them.
Interesting view. Thank you very much, Konstantinos.
Thank you.
Thank you.
Thank you
all.